Let me share a personal story with you. Last year, I invested into a crypto fund only to watch it plummet by 30% in 1 month. Now, don't get me wrong, there are the highs and lows of crypto, and there are people thousands of percent. But if you want to discover my own plan to have a £1 million ISA in 7 years by investing in only index funds, you're going to want to listen to this video about my top 5 index funds for 2025. I've discovered 5 index funds that could transform your investment strategy for 2025 and beyond. These funds offer unique advantages that might surprise you. One could even significantly boost your returns compared to the usual options. Stay tuned to learn how these game-changing funds could improve your portfolio and potentially secure your financial future. You will not want to miss this. Picture this, you're riding the entrepreneurial roller coaster. 1 month you're celebrating a big client win, the next you're wondering when the next paycheck will come. Does this sound familiar? It's a common scenario for many business owners, and it's exactly why we need to talk about the Vanguard 500 index fund, Admiral Shares. This is an index fund that tracks the performance of the S&P 500, which includes the top 500 companies in the US. Think of it as hiring a super reliable employee who consistently outperforms expectations without demanding a hefty salary. Now, income inconsistency is a real pain for entrepreneurs. In 2023, a study showed that small business owners experience income swings of up to 30% from month to month. That's a lot of financial stress to deal with. But here's where this fund comes to save the day. This index fund has been a top performer, delivering an impressive 14% average annual return over the past decade. Let's break this down what this means for your wallet. If you invest $500 every month into this fund, after 5 years, you could be looking at around $40,000 invested. After 10 years, that same investment could grow to over $116,000. And if you stick with it for 20, you're talking about a potential nest egg of nearly $500,000. Now, let's compare this to a typical savings account with a 1% interest rate. That same $500 monthly would only grow to $132,000 after 20 years. The difference is absolutely staggering. But this fund isn't just about long-term growth, it also pays dividends, providing a nice stream of passive income. Now, based on current yields, a $100,000 investment could generate around $1,500 in annual dividend income. That's money you can use to smooth out those bumpy income months. Index funds consistently outperform 86% of actively managed funds. That means you're beating the pros without paying their fees or spending hours analysing stocks. It's a smart choice for entrepreneurs looking to build wealth and create financial stability outside of their active business ventures. All right, let's dive into the world of global opportunities. While we've been focused on the US market, there's a whole universe of potential just waiting to be tapped into. Now, what if I told you that the next Amazon or Google might not be born in Silicon Valley, but in Shanghai or Mumbai? That's where the iShares Core MSCI Emerging Markets ETF comes into play. Now, I get it. Sticking to what you know, the US market feels very safe, but here's the thing, by limiting yourself to just American stocks, you might be missing out on some serious growth potential. Let me paint you a little picture. Emerging markets are growing at rates that make developed markets look like they're standing still. We're talking about the economies that are rapidly expanding with a rising middle class hungry for new products and services. This fund gives you a ticket to ride this rocket ship of growth. Now, the fund spreads your investment across 2,800 companies in 35 different countries. Now, that's like having a backstage pass to the most exciting economic show on earth. We're talking about countries in Asia, Latin America, and other developing regions that are poised for explosive growth. But don't just take my word for it. Let's look at the numbers. The year-to-date return for this fund is 1.01%. Now, listen, that might not sound earth-shattering, but here's where it gets very interesting. This fund also offers a dividend yield of 2.8%. That means you're getting a steady income stream while your investment has the potential to grow significantly over time. Now, I want to talk about the real potential here. Historically, emerging markets have outperformed developed markets during boom cycles. To give you a little idea of what this could mean for your portfolio, let's do a little bit of time travel. Imagine you've invested $10,000 in this fund during some key periods of emerging market growth. The returns could have been substantial, potentially turning your investment into a much larger sum. But here's the kicker. Right now, emerging markets are trading at attractive valuations. In other words, it's like there's a sale going on and you have the chance to pick up some potentially high growth assets at a discount. This is the kind of opportunity that savvy investors and entrepreneurs get excited about. Let me give you some examples of the powerhouse companies that you'd be investing through in this fund. We're talking about the giants like Taiwan Semiconductor Manufacturing, which is at the forefront of the global chip industry, or Tencent Holdings, a tech conglomerate that's like Facebook, PayPal, and Netflix of China, all rolled into one. And don't forget Alibaba Group, of course, which is basically China's Amazon. These are companies that are shaping the future technology and commerce in the world's fastest growing markets. Now, I know some of you might be thinking, this sounds great, but how does it help me with my retirement planning? Well, That's where this fund really shines. By adding emerging markets to your portfolio, you're not just diversifying, you're turbocharging your potential for long-term growth. This could be a game changer for your retirement strategy, especially if you're worried about having enough saved up. Think about it this way, as an entrepreneur, you're used to taking calculated risks to grow your business. Investing in emerging markets through this fund is very, very similar. You're positioning yourself to potentially benefit from the rapid growth of these economies, which could translate into significant returns over time. This could be the difference between a comfortable retirement and a truly abundant one. Picture this, you're on a roller coaster ride and suddenly it drops like a stone and you get butterflies in your belly. That's exactly what the market did in March 2020 and is the way I certainly felt at the time. As entrepreneurs, we're used to risks, but that kind of drop can make anyone's stomach churn. But what if I told you there's a way to potentially boost your returns while creating a safety net? Let me introduce to you two powerful funds that work together like the anchor and sail of a ship. The Vanguard Total Bond Market ETF, also known as BND, and the Vanguard Russell 1000 Growth ETF, also known as VONG. BND is your anchor, giving you stability with US investment grade bonds. It has a super low expense ratio of 0.03%, so more of your money stays invested. Plus 70% of its bonds are AAA rated, and that's rock solid quality, trust me. VONG is your sail, catching the winds of growth. It's outperformed the S&P 500 with a 367% return over the past decade. That's just over 16% annually, and it focuses on large cap US growth stocks, especially in tech. Combining these funds can protect your portfolio when things get very rough. Portfolios with a mix of equities and bonds tend to be less volatile and recover a lot quicker. Many advisors suggest a 60-40 split between equities and bonds. This balance sets you up for growth while cushioning market crashes. Here's where it gets very exciting, everyone. By pairing VONG's growth potential with BND stability, you're not just protecting your wealth, you're speeding up your path to financial freedom. Now, when the market dips, your bonds buffer the impact, leaving you with more capital to grab those lower stock prices. Rebalancing is extremely key here. It's like adjusting the sails of your investment ship. After a market downturn, you might find your bond allocation has grown beyond 40%. By selling some bonds and buying more stocks through VONG, you're setting yourself up for bigger gains when the market bounces back. This strategy isn't just about minimizing losses, it's about positioning yourself to recover faster and stronger. It's like having your cake and eating it too. You're set up for growth opportunities while still having your cushion to soften the blow of market crashes. Imagine the peace of mind that comes with a secure financial future. That's what these 5 index funds could provide. Combining them creates a powerful portfolio strategy. Investing just $500 monthly could potentially grow to over $200,000 in 5 years. Here's how to start your journey. Choose a reputable brokerage like Vanguard, Fidelity, or Hargreaves Lansdown. Visit their website, open an individual investment account, and this could be a Roth IRA in the US or an ISA in the UK, and fund it with as little as $100. Begin with an index fund and expand from there. My challenge to you is to open an account today, or if you have one, to start investing right now. Remember, your business is the engine, but these funds are the foundation. They're like sturdy beams supporting your entrepreneurial dreams, working silently in the background while you focus on running your business day to day. Finally, people, remember, always seek your own financial advice from a professional advisor before you make any investment decisions. And let me know in the comments below when you've started your investment journey. And as always, my friends and followers, if you've enjoyed this video, smash a like, subscribe to the channel, and I'll see you all in the next one.